Every financial crisis has a single root: the world is built on debt. The United States owes $38 trillion. Japan owes $9.4 trillion. China owes more than $14 trillion. The European Union owes over $15 trillion. And together governments, corporations, and households now carry $315 trillion of debt, while the global economy produces only $105 trillion a year. Here's the question that exposes everything. If every major nation is buried in debt, who is the world actually paying? The answer is not a single banker or a secret family. It is a system. A system designed over 331 years, built in 4 separate moments by 4 men who never met each other but solved the same problem in 4 different eras. In 1694, one man discovered how governments could borrow forever. In 1815, another spread that debt across an entire continent. In 1913, a third created a buyer with unlimited money. And in 1982, a fourth found a way to keep bankrupt countries paying interest forever. Together, they built the financial machine we live in today. A machine that powers economies, funds wars, fuels growth, and transfers wealth upward every single year. This is the story of that machine, and why no country on earth can truly escape it. To understand how the modern world became dependent on debt, we need to return to England in the late 17th century. The year is 1694. England is fighting an expensive war against France, and the treasury is empty. Tax revenues are not enough. Gold reserves are falling. Traditional lenders refuse to provide more credit because England has already defaulted in the past. The government is running out of options. Without new money, the war will be lost. This crisis opened the door for a Scottish merchant named William Paterson. Paterson was not a famous banker. He was not a royal advisor. But he understood something that very few people of his time could see. A government does not need gold to survive. It only needs a reliable stream of payments backed by its power to tax. His proposal was radical. Paterson offered to organize a group of wealthy merchants to lend the government £1.2 million. That would be worth hundreds of millions of dollars today. The amount was huge, but the structure was even more groundbreaking. The government would never repay the principal. It would only pay interest, year after year. Forever. This idea created a new financial institution, the Bank of England. The merchants deposited their gold into the bank. The bank then lent that gold to the government. Parliament guaranteed the interest payments at 8% per year. As long as England existed and could collect taxes, the money would continue to flow. This arrangement did something extraordinary. It turned government debt into a permanent asset. The merchants received paper notes representing their share of the loan. These notes could be traded, bought, and sold. They acted like money, but with one powerful advantage: they paid interest. For the first time in history, government debt became a form of currency. The consequences were immediate. England gained a stable way to finance war, expand its navy, and compete with France. Debt allowed the country to fight longer and project power further. At the same time, the cost of this strength shifted toward the public. Citizens paid taxes not only to fund government spending but to service a debt that never decreased. This new model marked a turning point. Before 1694, national debt was temporary. It was either repaid or written off through default. After 1694, debt became permanent. It became part of the government's operating structure, and it laid the foundation for a financial system where borrowing would grow with the ambitions of the state. Paterson's invention did more than save England during a war. It changed how nations finance themselves. It created a world where debt is not a burden to eliminate, but a tool to expand political and military power. And once England proved the model worked, other nations soon followed. By the early 19th century, England's invention of permanent national debt had already reshaped the financial world. But it was still a system confined within borders. Each country managed its own debts. Each lender dealt with risks limited to one nation. The idea of a truly international debt market did not yet exist. That transformation came from a single family, the Rothschilds. At the start of the 1800s, Europe was unstable. Wars erupted across the continent. Governments needed money quickly. They needed more than domestic banks could provide, and they needed access to capital that could move faster than diplomats or armies. This was the moment when 5 Rothschild brothers built something unprecedented. The brothers established banking houses in London, Paris, Frankfurt, Vienna, and Naples. No other financial group had this reach, and no government could match their speed of communication. They used couriers, coded letters, and later the telegraph to move information across Europe faster than anyone else. Nathan Rothschild, based in London, became the driving force. His innovation was simple but transformative. Instead of lending directly to governments, he bought large quantities of government bonds. Then he used the family's network to sell these bonds to investors across the continent. This created a new kind of market. A French investor could hold British debt. A banker in Vienna could buy bonds issued by Prussia. Capital flowed across borders for the first time in history. This new system had profound consequences. Before the Rothschild network, a government that could not repay its debt might simply default. A few wealthy creditors would take losses. The damage was contained, but once bonds were held by investors spread across Europe, everything changed. A default in one country would cause losses everywhere. Banks would fall, creditors would panic, and governments would face pressure not only from their own citizens but from foreign investors as well. Debt became interconnected, and interconnected debt became unbreakable. If a nation struggled to repay its loans, it could not easily walk away. The political cost of default was enormous. Governments were forced to borrow more to maintain payments on old debt. Reputation became as important as revenue. A country that lost investor confidence faced higher borrowing costs or complete exclusion from the bond markets. By 1850, the Rothschilds were not just bankers. They were the central hub of Europe's financial system. Their approval made it possible for governments to borrow. Their network set the interest rates nations paid, and their influence extended from the British Empire to the courts of Austria and Russia. England may have invented perpetual debt, but the Rothschilds globalized it. They turned government borrowing into a continent-wide web, one so tightly woven that no nation could tear its way out without harming itself and its neighbors. Yet even this global network had limits. It worked only as long as countries could find buyers for their bonds. In the 20th century, the world would discover a new kind of institution, one that could buy unlimited amounts of debt at any time. As Europe entered the 20th century, the global bond network created by the Rothschilds was powerful, but it still depended on one condition. Governments could borrow only if investors were willing to buy their bonds. When confidence collapsed, borrowing dried up, and when panic hit, the system froze. The United States learned this the hard way. In 1907, the country faced a devastating financial crisis. Stock markets plunged. Banks ran out of cash. Ordinary Americans lined up outside, failing institutions desperate to withdraw their deposits. There was no central bank to stabilize the system. No lender of last resort. The entire economy depended on one man, J.P. Morgan. Morgan gathered the heads of New York's largest banks inside his private library. He locked the doors and refused to let anyone leave until they committed their own money to rescue the financial system. His intervention prevented a complete collapse. But the crisis revealed a deeper truth. A modern economy could not rely on a single individual to stop systemic failure. The country needed a permanent institution capable of creating liquidity during panics. However, Americans were deeply suspicious of central banking. Twice before, the United States had created a central bank, and twice it had been dissolved after fierce public backlash. To many citizens, a central bank seemed like a tool for elite control. Any new proposal faced political resistance. This led to one of the most important and misunderstood events in American financial history. In November 1910, a small group of bankers, government officials, and financial experts secretly traveled to Jekyll Island, a private resort off the coast of Georgia. Among them were Senator Nelson Aldrich and executives from major banking firms connected to Morgan's circle. For 9 days behind closed doors, they drafted a plan to redesign the nation's monetary system. Their goal was practical. They needed a structure that provided stability during crises but also appeared decentralized enough to gain public acceptance. The result of their secret meeting became the foundation of the Federal Reserve Act. In 1913, Congress passed the act and created the Federal Reserve System. It was presented as a network of 12 regional reserve banks, overseen by a central board. But beneath this design was a dramatic shift in financial power. For the first time, the United States had an institution with the authority to create money. The Federal Reserve could now buy government bonds using newly issued currency. This changed the nature of debt forever. Before the Fed, the government could borrow only the money investors were willing to lend. After the Fed, the government could issue debt in any amount knowing the central bank could step in to purchase it. This effectively made government borrowing limitless. Treasury bonds became the foundation of the American financial system. Banks held them as safe assets. Investors trusted them more than any other instrument. And during wars, recessions, and national emergencies, the Federal Reserve ensured that demand for government debt never ran out. This new system financed World War I, stabilized the economy during the Great Depression, funded World War II, and supported the vast military and industrial expansions of the Cold War. Debt became essential to national policy. It no longer reflected the strength of the economy. It became one of the engines driving it. But limitless borrowing came with a hidden flaw. It worked only as long as the government could manage the interest payments. When interest rates rose sharply in the late 20th century, the world discovered what happened when nations could no longer keep up. By the late 20th century, the financial world seemed stable. The United States had a central bank with the power to buy its own debt. Europe had a mature bond market. Developing nations were borrowing heavily to build roads, power plants, ports, and entire cities. Money was flowing across borders faster than ever before. But this stability was fragile. It depended on one condition. Interest rates had to stay low. When interest rates rise, debt becomes dangerous. Payments balloon. Currencies weaken. Foreign investors panic. And in 1979, the world was about to learn this lesson on a devastating scale. Inflation in the United States had surged above 10%. Prices were rising every month. Confidence in the dollar was collapsing. Foreign governments were questioning whether the American financial system had lost control. To restore order, the new chairman of the Federal Reserve, Paul Volcker, made a decision that would change the next 40 years of global finance. He raised interest rates to almost 20%. It was the most aggressive monetary tightening in American history. Inside the United States, the move crushed inflation. But outside the United States, the impact was catastrophic. Throughout the 1,970 seconds, developing countries had borrowed billions of dollars, mostly in U.S. currency. They had taken these loans at low interest rates, expecting that global conditions would remain stable. Volcker's decision destroyed those assumptions. When rates climbed, their interest payments tripled. Countries like Mexico, Brazil, and Argentina found themselves trapped. Their export revenues were not enough to cover the cost of their dollar-denominated loans. By August 1982, Mexico announced that it could not meet its payments. It was the first major sovereign default of the era. But here is the critical part. A Mexican default did not only threaten Mexico, it threatened the American banks that had lent the money. If Mexico stopped paying, large U.S. institutions, including Citibank, Chase Manhattan, and Bank of America, would face billions of dollars in losses. A banking collapse inside the United States was a real possibility. The world needed a solution that would keep the payments flowing. The International Monetary Fund stepped in. The IMF created what it called structural adjustment loans. These loans did not reduce the original debt. They did not cancel interest. Instead, they supplied just enough money to allow countries to continue paying their creditors. But the assistance came with strict conditions. Governments had to cut spending, privatize state-owned companies, remove trade protections, and weaken their currencies. In exchange for temporary relief, they had to surrender part of their economic sovereignty. This approach set a new precedent. When a country could not pay, the debt was not forgiven. It was restructured, extended, and made permanent. The same pattern repeated around the world. Argentina in 2001, Greece in 2010, Sri Lanka in 2022. Each crisis followed the model created in the 1,980 seconds. Countries borrowed in dollars. Interest rates rose. Debt became unmanageable. The IMF stepped in with new loans. The payments continued, and the debt remained. This is the final piece of the system. Paterson made debt permanent. Rothschild made debt global. The Federal Reserve made debt unlimited. And Volcker made debt inescapable. By the end of the 20th century, every major economy was locked inside the same structure. A world where governments borrow without the expectation of repayment. A world where debt rolls over endlessly. A world where financial stability depends on the continuous flow of interest payments. Today, the global total exceeds $315 trillion. The system is larger, more complex, and more interconnected than at any point in history. The question is no longer whether countries can repay their debts. The question is what happens if they ever stop. 3 centuries ago, debt was a temporary problem. A king borrowed, a war ended, a loan was repaid or written off. But today, debt is not temporary. It is the foundation of the modern financial world. It is the system that governments use to fund budgets, support economies, stabilize markets, and project power. The numbers show the scale of this transformation. The United States carries $38 trillion of federal debt. Japan carries $9.4 trillion. China carries more than $14 trillion. The European Union carries over $15 trillion. And globally, the total is $315 trillion. This is not an accident. It is the result of the 4 turning points we have explored. In 1694, William Paterson discovered that a government could borrow forever by paying interest instead of repaying principal. In the early 19th century, Nathan Rothschild created the first global bond network, making sovereign debt international and interconnected. In 1913, the Federal Reserve gave the United States the ability to create unlimited demand for its own bonds. And in 1982, Paul Volcker's rate shock forced the world into a new cycle where countries that could not pay were not allowed to default, only refinance and continue. Each stage made the system stronger, deeper, and harder to escape. Today, government debt is not just a liability, it is also money. Treasury bonds are the backbone of pension funds, mutual funds, insurance companies, and global banks. They are used as collateral in financial markets. They support the savings of millions of households. If governments paid off their debt, most of the money circulating in the global economy would simply disappear. This is the paradox. The world cannot live with this debt, and it cannot live without it. Even the identity of the creditors has changed. It is no longer a small group of aristocrats or a single banking dynasty. The largest holders are now enormous asset managers like BlackRock, Vanguard, and State Street. These institutions do not lend their own money. They invest on behalf of pension funds, retirement plans, and millions of ordinary people. Yet the structure of the system still directs interest payments upward, from taxpayers to the institutions that control global capital. This is why the debt keeps rising. Not because governments are irresponsible, but because the system was built to grow. The machine works as long as confidence holds. As long as investors believe governments will pay interest. As long as central banks step in when markets panic. As long as new debt replaces old debt without interruption. But the system also carries a quiet warning. The more it expands, the harder it becomes to stabilize. The more interconnected it becomes, the greater the risk of contagion. And the more dependent it becomes on constant borrowing, the more fragile the global economy grows. Every nation is inside this machine. Every citizen pays into it. Every crisis tests its limits. The architects who built it could not have predicted how far it would evolve. But they understood one truth. Once you create a world where debt is the lifeblood of money, the only true disaster is breaking the cycle. That is why no country can escape. The system does not allow it. Debt is not the problem. Debt is the structure.